Dear students of the School of Business, Bangladesh Open University and the viewers, Assalamu alaikum. I welcome you all in today's program. Today's topic, Basic Accounting Concepts, the underlying assumption for the preparation of financial statements, has been selected for the students of Commonwealth Executive MBA, General MBA, BBA, PGDM and the Certificate in Management program for the School of Business of Bangladesh Open University. Today's topic has been carefully selected since this acts as the foundation for accounting discipline. Dear students, you know that accounting is an information system. It provides data and information to the internal and external stakeholders through the financial statements. Therefore, the stakeholders must make sure that the financial statements has been prepared depending on some common rules and regulations. These common rules and regulations is often termed as generally accepted accounting principle. The synonyms often used for the generally accepted accounting principles or GAAP are standards, concepts, conventions, doctrines, rules, regulations and so on. Dear students, now let us discuss in brief the basic accounting concepts and conventions one by one. The first one is economic entity or the business entity assumption. The business organization is treated as a separate entity. It is not only separate from the customers or the creditors, it is also separate from the loan provider or the owner of the business. Thus, business organization is treated as an artificial entity, and since as an artificial entity, business organization does not have the capability to generate capital, it is assumed that the owners provide loan the capital as the capital to the organization. And that is how the capital is treated as an internal liability for the organization to its owners. The second assumption we are going to discuss is the money measurement assumption. This assumption reveals that the transactions that only can be measured in monetary terms should be recorded for the purpose of preparing the financial statements. Thus, for example, the death of an efficient manager of a business organization is obviously a loss for that organization. However, it cannot be recorded as a transaction since it cannot be measured through monetary terms. Same way, if we say like that the business organization possesses a piece of land, 2 factory buildings, 1 administrative building, lot of costly plant and machineries and furniture, it does not make any sense for the preparation of financial statements. However, if we say like this, that we have our piece of land that cost 10 million, 2 factory buildings that cost 50,000 million and so on, it can be recorded in the books of account since it makes sense. The going concern assumption. As per this assumption, once the business organization is incorporated, it will continue its operation for an unlimited future period. And under this assumption, the owner invests capital, the business organizations invest in long-term fixed assets, it takes loan from the banks and other financial institutions, invest in other assets, and thus it carry forwards the balances of assets and liabilities and the capital of the owner for the next accounting period. The next one we are going to discuss the periodicity assumption. According to this assumption, the total life of a business organization is divided into small chunks of time period, and it is usually one accounting period, and the fiscal period is from 1st January to 31st December, that is the calendar year. If this couldn't be done, it wouldn't be possible for the stakeholders of the organization to know about the financial condition of the organization. They wouldn't be able to know about the position of the assets and liabilities of an organization, the equity of an organization, how much the total net income for a given period of time. And for that, they have to wait till the liquidation of the organization. The stakeholders like the owners, creditors, the suppliers and other parties want to know about the financial health of an organization at frequent duration of time. And for this purpose, the total life of the organization is divided into small chunks, and it is usually according to the calendar year, that is from 1st January to 31st December. The historical cost principles. This principle asserts that the long-term fixed assets of an organization should always be recorded at its original acquisition price, that the original sacrifice made for the purchase of the asset. This cost is relevant, reliable and objective. Every year, the accumulated depreciation of the long-term fixed asset should be subtracted from the asset, and the book value or the written down value should be shown in the balance sheet. However, one thing to be noticed, that all the assets should not be recorded at its cost. For example, conservatism approach is followed to show current assets like inventory or stock at cost or market price, whichever is lower. The revenue recognition principle. Under this principle, the emphasis is on the timing of the recording of revenue. As per this principle, the revenue should be recorded on the basis of accrual accounting, not on cash basis, which means that as we provide the services to the customers, for example, for a service organization, we should record the event as a financial transaction in the books of accounts, not when the cash is collected. Therefore, it is important for a service organization whether the services has been provided within the accounting period, not whether the cash has been collected. Same way, for a merchandising organization, the revenue should be recorded if the ownership of the goods has been transferred from the seller to the buyer, not when the cash is collected. The matching principle. The main thing of the matching principle is that for a given period of time, the expenses of an organization should be properly adjusted against the revenue of an organization for a given period of time. For example, when we purchase an inventory, it is recorded as an asset, and until and unless we sell the asset, it is not recorded as cost of goods sold. The expenses is an expired item, and it should be properly adjusted against the revenue for a given period of time to properly calculate the net income for that particular period. Let us take another example to understand this concept. If an employee takes salary as advance from an organization, it is not recorded as salary expense. It should be recorded as advance salary, which is an asset for the organization and a liability from the viewpoint of the employee. And as the employee provided services, the advance salary will be recorded as salary expense as the time expires. The full disclosure principle. Dear students, we know that the organization can finance itself from two sources, that is the debt financing or the equity financing. That is, the fund is provided either from the owner or from the loan provider like the bank or the other financial institutions. Thus, the stakeholders has the right to know about the financial condition of an organization. The organization should provide the data and information in such a way that it becomes self-explanatory to the organization. In compliance to this principle, additional data, explanation, schedules, etc. are attached as supplementary information for the users for making decision. For example, significant loan agreement against mortgage of an asset, accounting methods employed, for example, for charging depreciation, change in accounting method, and explanation regarding why it has been done for all these should be disclosed properly. The materiality. It emphasizes on the importance and significance of an item and thus its importance and use on the financial statements. An item is considered as material when it influences the decision making process of the investors. For example, if an organization purchases a waste paper basket, it may have a useful life for more than 1 year. However, the price of the waste paper basket is so negligible that it should not be recorded as an asset, it should be rather recorded as an expense for the organization for that relevant particular period. Thus, the determination of what is material and what is immaterial depends on the judgment. Precise criteria cannot be fixed. The next one is conservatism. This constraint refers to situations as when two methods are otherwise equally appropriate. The choice should be made for the one that will least likely to overstate assets and income. In accounting practices, all possible losses are accounted for, whereas expected income or revenue are not recorded until it is earned. Thus, accountants are conservative and follow a slogan, anticipate no profit but provide for all possible losses. Another example of the application of this constraint is that the inventory is valued at their cost or market price, whichever is lower. Dear students, so far we have discussed about the basic accounting principles for the preparation of financial statements. These are very important to understand since these acts as the foundation or basis for the preparation of financial statements. You will be more benefited if you read through the chapters properly from your text. No more today. Thank you for watching our program. Thanks a lot.